So let's understand what is a derivative. You can see the definition on the screen, right? It's visible. है
Yes,
ना?
sir. Yes.
चलो. Okay. So a derivative is a security. Now over here, security is not the English word secure, not security in that sense, not like security guard. It's just
Instrument.
a financial instrument.
Financial instrument. Yes.
Yes. So you know what is a financial instrument with a
Yeah.
value
Hmm.
that is dependent upon or derived from the prices of one or more underlying assets. Okay, the prices of one or more underlying assets. The derivative itself is a contract between two or more parties based upon the asset or assets. Its value is determined by the fluctuation in the underlying asset. Four common type of derivative instruments are forwards, futures, options, and swaps. You already know the terms. We will get to the meaning. But let us understand this in detail. First of all, what I'm saying is derivative is a contract between two or more people. Let's keep it two for the sake of simplicity. So Mr. A and Mr. B have entered into a contract of some kind. Okay. And the value of this contract depends upon something else, some other commodity, some other asset. Then the value of this contract between A and B is always derived from the price of some other asset. That other asset is called underlying, and this contract is called derivative. Let me explain this to you with the help of an example, then it will be very clear. Have you ever entered into a forward contract in your life?
No, sir.
No? Someone in your family?
No, sir. No one.
What if I tell you you have entered into, either you or someone in the family, close family, have done a forward contract, you just did not know that this is called a forward contract.
I have no idea whether they are done forward contract or not.
I'll tell you what it is. Okay, I'll tell you. I'll give you an example.
Yes, sir.
If you want a box of sweets, first of all, tell me, do you understand the word contract?
Yeah, agreement between two parties to do financial obligations.
Agreement between two parties. An agreement means I'm giving you something and I'm getting something in return, and we are both agreeing that I give you, let's say, a box of chocolates and you pay me 200 rupees for that if I'm a chocolate seller, suppose.
Yes.
Okay, and this agreement is legally enforceable. That means it is valid agreement as per law. Then it is called a contract. Okay. Now,
Yes.
suppose you want to just buy a box of sweets, a box of laddus or gulab jamuns or whatever, any sweet. What is the process you follow? You will go, so this is you, and this is the sweet seller, the sweet shop. You will go to the sweet shop, you will identify the sweet you want. Suppose you want some kind of laddu. So you'll identify, I want this laddu. Okay. Then you will specify the quantity.
Yes.
Maybe there are two or three different qualities available, one with dry fruits, one without dry fruits. So you'll pick the quality. Then you'll tell the shopkeeper the quantity. I want half a kg, I want 1 kg, whatever quantity you want. So you've identified the goods, the quality, the quantity, and then you will ask for the price. And suppose the shopkeeper says, whatever, maybe, I don't know, 500 rupees a kg or whatever. If you like the price, fine. Otherwise, you might negotiate. No, I will pay 450. The shopkeeper will not agree. Then somehow you will arrive at, let's say, 480 or whatever price. So you negotiate the price, you finalize the price. Okay.
Yes.
After that is done, you pay the money and you get the laddus immediately.
Okay.
Correct?
Yes.
Now, what happens if there is one happy occasion in your family? Maybe some marriage is happening or something, and you want to distribute 500 boxes of laddus to your friends and acquaintances and family members and others. We do that, right?
Right.
So are you just going to walk into a shop and demand 500 boxes? They may not have that much quantity of laddu ready. Even if they have it ready, it may not be all of that, all the 500 boxes will be of the same quality,
Hmm.
because they might not have that much in stock. Even if they have it in stock, it might not be in the kind of packaging you like. Maybe you want a nice box, maybe you want to put a card on it with your name, greetings from Akash and family, whatever, something like that.
Yes.
Okay, so you want a customized product. You don't want something that is there in the shelf. You want it customized. You want customized packaging. You want a specific quantity. So what are you going to do? If you want to distribute the laddus tomorrow, are you going to go to the sweet shop tomorrow morning?
No, sir.
What will you do?
Customize the product, sir. If
You
you
are
want
going to not, you are not going to customize it. You have to tell the shopkeeper, when are you going to go there?
before the marriage, sir, before marriage celebration,
So when
before
you want to distribute the sweets, suppose tomorrow morning you want to distribute the sweets. When are you going to go to the shopkeeper?
that much earlier, sir,
Much earlier. Let's say 15 days in advance. So this was case one when you went there and bought the laddu.
because it takes much
This-
time. Because it takes much time, no, so to
Yes, you have
distribute.
to place the
Yeah.
order in advance.
Yes.
So in now we are talking of the second situation. You are placing the order in advance. You go to the sweet shop. You say that on particular date, let's say on 15th of August. So you're specifying the date. On 15th of August, I need 500 boxes. Sorry, uh, let's say 100 boxes. I need 100 boxes of this quality of laddu, and each box must have 1 kg laddu. And I want packaging in this color box, and I want a label on that box which reads like this. So you provide all the details. The shopkeeper provides you with the price. So the quality and the quantity, and then shopkeeper offers you a price. If you agree to it, fine. Otherwise, you negotiate and come to an agreement. So the price is also determined. The quality is determined, the quantity is determined, the price is determined. It is just that you are not going to pay the price today, and you are not going to receive the laddus today. Okay. So when you enter into a contract, there is an agreement. In this case, you entered into an agreement with the shopkeeper, and immediately there was a settlement also. That means, sorry, settlement. That means you paid the money and the goods were delivered. That means the laddus were delivered. You paid the money, you received the goods. In this case, what is happening is the agreement is happening now, okay? But
Hmm.
the payment as well as the delivery will happen when? Not now, but on 15th of August.
Yes, sir.
So this is also a contract, just like this one. There is no difference. Both of them are contracts, except for one difference. And that difference is, in the first one, the agreement and the execution or settlement of the contract happened immediately. The agreement happened immediately after that, the settlement happened.
Hmm.
The execution happened. So he actually took out 1 kg laddu, packed it in a box, gave it to you. You immediately paid the money. This is execution of the contract. First, you are agreeing to do it, and then you are actually doing it. That is called execution of the contract. In the second case, the agreement is happening now. All aspects of agreement, the quality, the quantity, the price, everything, what kind of packaging. But the execution is not happening now. Execution will happen at a date in future. That is after 15 days or 20 days, 15th August.
Hmm.
Clear?
Yes, sir.
Both are contracts. This one is a normal contract. This one, the second situation, is called a forward contract. Now tell me, have you ever entered into a forward contract? Either you or maybe your father, mother, some family member. Yes,
No.
of course,
Yes.
almost everyone has, at some point or the other, everyone would have entered into such a contract when they order something in advance.
Yes, sir.
Right? So
Yeah.
this
Okay.
is what a forward contract is. Nothing
Yes.
special about it. It is just like a normal contract with one difference, that the execution of the contract happens at a date in future, and not any random date, a fixed specified date. So
Yeah,
at that time you
yes,
will
sir.
make the, yes.
Yes, sir. Many times we had a forward contract then, sir.
Yes, but you just didn't know that this is what a forward contract is. You didn't know that this is called a forward contract, but you've done forward contracts. So the payment and the delivery of goods happen at a specified future date. Now, you have to make the whole payment in a future date. In reality, for practical purposes, maybe you have to pay a small amount of advance, like maybe 10% of the total value. If the total laddus are going to cost you, let's say 5,000 rupees, maybe you will pay 500 rupees as token money, but you're not making payment for the whole contract.
Yes,
That will happen on 15th August. You will give the money, you will get the laddus. So agreement happened today, execution not happening immediately, happening after a few days. This is called a forward contract. Clear?
sir. Sir, future. What about future contracts, sir? Because I think future contract also you buy and sell something at a specific price on a future date. No, sir.
We will come to future contracts a little later.
Oh, okay,
First,
sir.
let us understand the definition of derivatives with the help of a couple of examples. Then we will come back to the definition of forward and future, and what is the difference between them, what are the similarities between them.
Yes,
All
sir.
right, fair enough.
Yes, sir.
Okay, so this was a simple case of buying laddus, but very often you enter into contracts not for buying laddus but for buying things for commercial purposes, or
Okay.
things that have a lot of financial value. Let me give you an example.
Yes.
Suppose this is you, and this is a jewelry shop. B is a jeweler.
Hmm.
Okay. Suppose there is some occasion, maybe a festival or maybe a ceremony, and you want to gift some gold to someone. You want to give gold to your uh, parents or some family member.
Hmm.
Okay. Currently, the price of gold today in the market is, let's say, 10 grams. I'm just taking round figure, 50,000.
Yeah.
Right now, you are thinking, because you study financial markets and you are a financial analyst, you analyze the numbers and what's happening in the gold market, and you feel that the gold prices are going to go up in the next 1 month.
Hmm.
Okay. And you want to, obviously you have to buy gold, so you don't want to pay more for the gold. So you say that I will go to a shopkeeper and I will fix the price today itself. Instead of waiting for 1 month to buy gold, I am going to enter into a forward contract to buy gold, just like I did with laddus. I can negotiate with the shopkeeper. I will decide the quantity, the quality, everything, and the price also. But uh, I'm not going to pay today, and I'm not going to take the gold today. I need it after 1 month. I will take after 1 month. Okay, so you decided, let me enter into a forward contract for buying gold. So you went to the shopkeeper. Currently, the price is 50,000. You said, I need 10 grams of gold exactly 1 month from now. So you are fixing the quantity, 10 grams. You are fixing the time exactly after 1 month. And you will also negotiate and fix the price. The shopkeeper says, okay, I will give it to you after 1 month for, sorry, uh,
One month. Yes.
let me write it here. I will give it to you after 1 month at the rate of 51,000. The shopkeeper wants to charge a little extra because the shopkeeper also believes that the prices are going to rise. And you feel the prices will rise a lot more. So if you get it for 51,000, still it is cheap, right?
Yes, sir.
Now, these two are the parties to the contract. This price, although it has nothing to do with their contract, This is the price of gold in the market today. When they enter into the forward contract, this is the price if you buy gold for cash now. If you give cash now, you will get it for 50,000.
Hmm.
Right now, you will get the gold. So this is called the spot price.
Okay. This is the original price, right?
This is the current price. If you give cash now, if you are doing the agreement and executing it immediately, then this is the price you have to pay if you are buying gold immediately.
Okay,
But
okay.
if you are trying to buy gold after 1 month, but the agreement you want to do now, you want to do a forward contract,
Future
then
price, right?
obviously he will not give it to you at this price. He might ask for something more. So that is this price. He's
Future
put,
price, right?
huh?
It is called future price, right?
It is called future price or it is called forward price.
Yeah, yeah. Yes, sir. I
Okay.
got it. That 51,000 is the future price.
51,000 is the, let's call it forward price for now,
Yes, sir.
because we are not discussing futures yet. Futures and forwards are essentially the same. You'll come to know.
Yes, sir. Same.
Okay,
Yeah.
so let's just call it the forward price. So you have discussed the quality, the quantity, when the time, exactly 1 month later, this will be executed. At what price? Forward price, that is 51,000 for 10 grams.
Yeah.
Okay, so you have an agreement in place. This is a contract between two parties to buy gold. How much? 10 grams. So certain quantity of gold, certain quality of gold, when exactly 1 month. So date is also fixed and price is also fixed. That is the forward price. This is what the definition we read: buy something at a future date, buy or sell something at a future date, a contract between two people to buy or sell something at a future date. This is the definition we read, right?
Yes, sir.
So this is what a forward contract is. Now there was another part of the definition which said the value of this contract is derived from the value of underlying. Let's understand that part. Agreement part we've already understood. Okay, so let's move forward 1 month. After 1 month, suppose you were absolutely right. The prices of gold have risen up very sharply. And after 1 month, if you go to the market, you can get 10 grams of gold for how much? Let's say you can get it for 55,000. This is the price of gold in the spot market after 1 month. This is the spot price after 1 month. Is this clear?
Hmm.
After 1 month, on that day, today is what date? 24th of July.
24th. Yes, sir.
24th of July. So suppose 24th of July, the price is 50,000 in the spot market. You, after 1 month, 24th of August, we are there. On 24th of August, you just check in the market. You can go to the market and get 10 grams gold for 55,000. So this is the spot price on 24th of August. 55,000 is the spot price on 24th of August.
Hmm.
But you need 10 grams gold. You are going to go to the market. You are not going to pay 55,000. You have already entered into a forward contract with the shopkeeper who's going to give it to you at this price. You already entered into a contract, right? So why will you pay in the spot market? Why will you pay 55,000? You will simply go to the jeweler, you will give him 51,000 and he will give you 10 grams gold. Is
Yes,
this
sir.
part clear?
Yes, sir. If
Can
you're
he
paying,
refuse? Can he refuse? Can he charge 55,000?
if you're paying in the future date, sir, then he will increase the price, no, a little bit.
You have entered into a contract on 24th of July. You entered into a contract that on
Yes.
24th of August, I will buy 10 grams of gold from you at
Yeah,
51,000.
the shopkeeper will not
Now,
refuse.
now
Yeah.
can he charge 55,000 for the gold? No.
No, sir. No, now he can't charge. If you're paying immediately, sir, he'll give you, he will charge
If you are buying in the spot market, yes, 55,000. But in this case, you already had a forward contract with him. And that forward contract, the forward price was 51,000. So now he cannot ask for more. See, he might not honor the contract. That is a different thing. He might just refuse to give it to you by breaking the contract. That's a different thing. But if he doesn't break the contract, if he's an honest person, then he cannot ask for more than 51,000.
If you're paying now, if you're paying now, he will not ask for
You
55.
entered into forward contract, right?
Right, sir.
On 24th of July, you entered into forward contract. So on 24th of August, when you go to him, he should ask for only 51,000 because that was the agreed price, this price,
Yes, sir.
because you had a forward contract with him.
Okay.
Is this clear?
Yes, sir.
Okay. So next point. What is available in the market for 55,000? Because of this forward contract, you can get the same thing for 51,000. Yes or
Hmm.
no?
Yes, sir.
Yes. Same amount of gold, same quality of gold. If you had to give cash and buy it in the spot market, you would have had to pay 55,000 for that. But because you entered into forward contract 1 month in advance, and after that the prices have really shot up, you get the same quantity and quality of gold for 51,000. Are you making a profit of 4,000 or not?
No, sir.
No. What is available in the market for 55,000, you are getting in 51,000.
Yes. It will be a loss. No, if you're giving 51,000 now.
You are the gold buyer,
Yes,
Akash.
sir.
You are not the jeweler. You are the gold buyer, remember?
Yes, I'm the gold buyer and you're the jeweler. Yes, sir.
For you, it is a profit of 4,000. Why? Because what is available in the market for 55,000, you can get it for 51,000. You are getting it 4,000 cheaper.
Right.
You're
Yes.
getting gold worth 55,000, but you don't have to pay 55, you only have to pay 51. So you're making a profit of
Four.
4,000. If this gold, you paid 51 for this, if you immediately go and sell it in the market, in the spot market, anyone will give you 55,000 for this, right?
Yes, sir.
So you are making a profit of 4,000.
Yes, sir. Oh,
Clear?
yes, sir. I got.
Okay. Now, suppose in the same situation, okay? You go to the jeweler and you do a forward contract for 10 grams gold, 1 month later 51K. Same example we are continuing. This is on 24th of July. Now on 24th of August, let's say 10-gram gold prices in the spot market were, uh, the prices did not increase, or let's continue with the same example. The prices increased, but not just by 5,000, by a lot more. So the prices became 58,000. Then on 24th of August, how much profit or loss will you make? What is available in the market for 58,000, you can get it for, this is the forward price, 51,000. What is available in the market for 58, you can get it for 51. How much is your profit?
Seven. 7,000.
7,000.
But sir, how is it possible, sir? If it is available in the market, sir, that price only have to pay. No. Why you have to pay 51,000?
Because you entered on, this is, you are buying the gold on 24th of August.
Yes, sir.
You entered into an agreement with the shopkeeper on 24th of July that I will buy 10 grams from you on 24th of August. After 1 month,
Yes.
how much price will you charge? The shopkeeper said 51,000. So you entered into a forward contract.
Yes, the shopkeeper will agree that 51,000. But
Yes,
even if even if it is available now only 58,000, he'll give you 51,000 because earlier you have entered into a forward contract earlier, right?
yes, 24th of July, you entered into a forward contract.
Yes, sir.
On 24th of August, he is going to give you 10 grams gold for 51,000. Does it mention anything about the price at that time?
No, sir.
Your contract, does it mention anything about the price? Does it say what is the price at that time? Depending on that, how much you will take? No.
No, sir.
It simply says on 24th of August, I will give you 51,000. I mean, the shopkeeper, you will give the shopkeeper 51,000 rupees and the shopkeeper will give you 10 grams gold. End of the story.
Yes, sir.
Doesn't matter what the price in the market is on that day.
Hmm. Yes,
Whether
sir.
the price is 1 lakh or whether the price is 50 lakhs or whether the price is 10 rupees, the shopkeeper is going to give you 10 grams of gold for 51,000 rupees. Clear?
Yes, sir.
That is what a forward contract is. Otherwise, what is the point of doing a contract?
Hmm.
Right? So, the contract is done, the forward price will remain 51,000. But if the market price or the spot price on that particular day is 58,000, you are going to make a profit of 7,000. Suppose the price is 65,000, the spot price in the market. In 1 month's time, gold prices have really gone up very sharply. But you will still get it for 51,000. Am I right?
Yes, sir.
How much profit will you make?
14.
14,000. The reverse is also possible. It is possible that the price in the gold market has collapsed in 1 month's time. On 24th of July, it was 50,000. You did a forward contract for 51,000. But on 24th of August, the prices have dropped. It is possible, right? Let's
Hmm.
say the prices have dropped to 48,000.
Hmm.
Over here, it was 50 in the spot market, but now it is 48,000 in the spot market.
So it's a
But
loss.
you have to buy it for 51,000. Can you tell the shopkeeper that, listen, it's 48 in the market? Why should I give you 51? No, you cannot say that.
It will be a
There
loss
was
then.
an agreement that on 24th of August, you will get 10 grams of gold and you have to give 51,000.
Yes,
In
sir.
this case, you are making a profit or a loss
Loss, loss.
of
3,000.
3,000.
Which means if the spot price is more than if spot price is less than the future price, then it is loss.
In case of buying transaction, yes. But for seller, it is the opposite.
Yes.
Okay.
Hmm.
This is your profit or loss. But the shopkeeper's profit or loss will be exactly the opposite.
First one is loss for first two are loss for shopkeeper, and last one is loss for me.
Last
Loss
one
for
is loss for you and same profit for shopkeeper.
yeah, profit for shopkeeper. Yes, sir.
Correct?
Last one.
Because what he can sell in the market for 48,000, he is selling to you for 51,000. So he's
Yes,
making a profit of 3,000 on that.
yes, sir.
Correct?
Hmm.
So you see, this contract between you and the shopkeeper, you can actually make a profit or loss on this contract. You can make money or lose money on this contract.
Yes.
So the contract has a value. Okay.
Hmm.
What is happening on 24th of July? Have you given any money? No. Have you got any gold? No. You have just got a legal right. Just because you entered into a contract. Wait. On 24th of July, you don't have the gold. You just have a legal right to receive 10 grams of gold at the rate of 51K on 24th of August. That is all you have. But this right, when you enter into a contract, you have a legal right. You understand that? Is that correct?
Sir, correct.
Okay. This legal right also has a value because it is possible on 24th of August, the prices may not be 51,000. If the price in the market on 24th of August is more than 51,000, you will make a profit on this deal, on this contract.
Hmm.
Therefore, on 24th of July, when you enter into this contract, which is a forward contract, immediately a right is established. Okay?
Hmm.
And it has a value. And the value keeps changing. And how much the value is changing depends upon what? It depends upon price of gold in the spot market. Clear?
Yes, sir.
So you enter into a forward contract, you get a legal right. This right itself has a value. The value keeps changing, and it changes in relation to the price of gold. That means gold is called the underlying
Underlying asset.
asset. See, on 24th of July, you've not purchased gold. So you should not be concerned about the price of gold. Your value is not changing because gold is going up or down, but because you have a right to buy gold at 51,000, because of that right, you are making a profit or loss. And it depends upon how much the price of gold appreciate, or if it goes down, you might make a loss. Correct?
Yes, sir.
Is this example absolutely clear?
Yes. Yes, sir.
Any questions you have?
No, no, sir.
So this is an example of forward contract. The value of the contract or this legal right, it has a value. That value is derived from something else, that is the movement of prices of gold. So gold is called the underlying.
Yeah.
Since the value of this contract is always derived,
Yes, sir.
wait, it is always derived. The value of this contract is always derived from the prices of underlying asset. These type of contracts are called derivative. That means the result of deriving. After deriving, what you get is called a derivative. This contract, okay, this forward contract, the value is derived from price of gold in the spot market, price of underlying. Therefore, this forward contract is called a derivative. So let's look at the definition of a forward contract that we just discussed. In a forward contract, the buyer and the seller, matlab two parties, there are two parties that agree to buy or sell an underlying asset. In our example, it was gold at a price that was the forward price. In our example, it was 51,000. They both agree on at an established future date. So this price is called the forward price, and the date is called the settlement date or delivery date. So 24th August is the settlement date or delivery date. Let me show you some examples of how forward contracts are used and
Yes.
who uses them. Now, in the example that we just discussed, where you wanted to buy 10 grams of gold after 1 month, why did you enter into a forward contract? On 24th of July, you could have bought the gold for 50,000, but you didn't need it on 24th of July. You required the gold on 24th of August. Correct?
Yes, sir.
You could have bought on 24th of August.
Hmm.
Why did you have to do a forward contract today?
Because of some occasion is happening, that's why.
Then occasion is 24th of August. You need to gift the gold on 24th of August, right?
Yes, sir.
Why are you doing the contract now? You go and buy on 24th or 23rd of August.
Yes,
One
sir.
day before you buy.
Hmm.
Why are you doing the contract today?
So that
Remember what I told you? You are doing financial analysis, and your analysis tells you that the prices might increase.
yes, prices might increase. Yeah.
Yes. Suppose you are buying it from your
Yes, sir.
pocket money.
Yes, yes, sir. I got it. So that the price is, so the price might increase.
Yes. So there is a risk. Suppose you have saved some money to buy this gift for your parents.
Yes, sir.
You want to buy 10 grams gold for your parents. You've
Hmm.
saved this money. You've earned and saved this money.
Hmm.
You have around 52,000 savings right now. What if the prices go up to 55,000? Will you be able to buy the 10 grams? No,
No,
you
sir.
will
No,
have
sir.
to
It's a
buy a
lot.
lesser quantity.
Yes, sir.
You
At
might,
lesser, yes, sir.
yes.
At lesser quantity, I want to buy, and I'll get profit of that.
Yeah. So what I'm saying is, that what is the reason, instead of waiting till 24th of August, why did you enter into a forward contract now? What benefit is it giving? Instead of paying 50,000 today, see, today the price is 50,000, but for the forward price, the jeweler said, I will charge 51,000 after 1 month. And you agreed to that because you are scared that the prices might go up even further. The prices might be 55, 56,000. So by entering into a forward contract, what is it that you're doing? You are fixing your price in advance.
Yes,
Am I
sir.
right?
Like,
You are fixing the price in advance. Once you have fixed this price, once you've entered into an agreement with the jeweler, this forward price is fixed. Now, how does it matter if the gold prices go up or go down? It doesn't affect you because
hmm,
you are still going to get it in the fixed price, the forward price. Am I correct?
hmm.
Right. So, by entering into this forward contract, you basically eliminated a risk. What was the risk?
Gold.
Gold prices might shoot up in 1 month's time. And if that happens, you would have had to pay more money. By entering into a forward contract, you eliminated that risk completely because now you know what you're going to pay.
But so you'll pay the less price, no, because the because the 1 month before you enter into a forward contract, no.
Hmm.
So you'll pay at that price, no. If the price is increased, the shopkeeper will say that you will pay at a
Yeah,
less
yeah, yeah.
price
You will
because
pay at that price only. That is what I'm saying. You will pay at the forward price only.
yeah,
That
yes,
means
sir.
51,000 only. On 24th of August, the price might be 80,000. Doesn't matter. You will still pay 51,000, the forward price.
Yeah, yes,
So
sir.
that is how you are eliminating the risk of gold prices moving up. Even if they move up, you are not impacted because you will still pay 51,000. So that risk is eliminated.
You'll get the profit of it. Profit.
Yes. Well, basically the risk is eliminated.
That
You're
is the
not doing
benefit
it
for
for
customer.
profit. You're not doing it for profit. You are going to uh, give the gold away to someone. Okay. You are doing it to reduce your risk.
There's a benefit for a customer.
Yes, yes, it is a benefit for the customer. What is the benefit? Your risk is getting eliminated.
Yes, sir. Risk is reducing. Yes.
If you are going to keep that gold or you're going to sell it in the spot market, then you will actually make a profit. But if you're going to give it away, then it is not really a profit, but you are getting your prices, the risk of prices moving up is getting eliminated. You
Hmm.
know in advance that you have to pay 51,000.
Hmm.
Okay. This is how a forward contract can be used for risk management.
But there can be loss also, na, sir. If the gold prices decrease decrease in 1 month, there might be a loss
Let
also.
me tell you, let me give you an example. After the second example, then it will be clear. Risk management or risk mitigation. Mitigation means to get rid of the risk.
Hmm.
Clear? This is one example. Okay, let me give you a real life how it happens. Let me give you that example. For example, currency. Suppose you are an exporter of anything, any commodity, or maybe even a service. For example, you know Infosys.
Yes, sir.
What are they doing? What business they are in?
The technology, sir.
Yeah, but what about technology? What do they do? Who are their clients? They give information technology and information technology related services. So
Hmm.
let me just call it IT services to their clients. Most of their clients are outside India. A very big majority portion of their clients are actually based in the US.
It's an IT company. Yes, sir.
Yes, so it provides IT services to clients, and most of them are outside India. A big chunk of them, they are in the America, the USA, United States of America.
Yes, sir.
So when this company is
But
providing any service to them,
so it
the
is
client is,
so Infosys also a listed company in New York Stock Exchange, sir.
yes, Infosys is also listed on NYSC, and obviously it is
NYSE.
listed in India. Yes.
Yes, it's yes. Yes.
Okay. Coming back. So IT services, and they get money for that.
Hmm.
Okay. How do they get the money? In what form do they get the money? There must be an agreement that we will do this service to you for you, and in return you will give us so much money on so and so date.
Yes.
Something like that.
Hmm.
But that money is in what form? Which currency? Which
With
currency?
USA in dollar.
Yes. So their earnings are in USD, that is American dollars. So suppose the client agrees to pay them, well, it's in millions, but I'm just keeping the number small to make it easy. The client is, let's say, as an example, going to give them $100 after 1 month.
Hmm.
To be able to do this work, they are going to get from client $100. Let me write USD 100. After 1 month, they are going to get this work. To be able to earn this $100 for the whole month, they have to do some work. They have to employ people also. There will be engineers, software engineers working on the project, and so there will be employees, and there will be many other expenses.
Hmm.
After 1 month, they are going to give salary also to the employees. This will be in which currency?
Dollars only, sir.
If you work for Infosys, you get paid in dollars.
No, no sir. In rupees only. In rupees.
In rupees. See, most of their workforce is in India. There will be a few people in the US also, but majority of the work is done in India.
Hmm.
Export means what? You are doing the work here and exporting it to someone else. Or you are making the commodity here. Suppose you make shirts and export it to America. Similarly, the service is being done out of India only. The
So
people who are doing it are sitting in Bangalore, Hyderabad, various other cities.
they get it in rupee only, sir. Rupees.
So
But
the
if
income
but
is
yeah.
in dollars, in
Hmm.
USD, but their expenses are in Indian rupees. So when the client pays them 100, what are they going to do? They cannot pay the salary in dollars. They cannot do that. They have to pay it in rupees. So they are going to convert these dollars into INR. They will give $100 to the bank, and bank will give them some amount of rupees. What amount of rupees will they get for the $100? That depends upon the exchange rate.
$1 is 75 rupees, sir.
75, who told you?
But nowadays 80, sir.
Now it has gone to 80.
Yeah, I
So
got the news. Yeah.
yes, so you are
Nowadays, yeah.
aware that the dollar INR rate in the market is, hello, are you there?
Yeah,
My
yeah,
screen froze.
yeah, yeah, your
Okay,
voice is cracking in between. Yeah.
okay. Now it's fine.
Yes, sir.
Okay. So you are aware that the dollar INR rate in the market is not the same. It keeps fluctuating every day.
Hmm.
So that means Infosys does not know that after 1 month, when I get this $100 and I try to convert it into Indian rupees, I don't know, I might get 7,500 rupees for this if the rate is 75, or I might get 7,800 rupees for this if the rate is 78, or I might get 8,000 rupees for this if the rate is 80.
Hmm.
I don't know how much money I will be getting, but I have to pay the salary and the other cost.
Hmm.
So there is a bit of risk for me because I don't know for sure how much my earning will be. I'm sure the earning will be $100, but in Indian rupees, how much I will get, that I don't know.
Hmm.
So to eliminate this risk, whether I will get more, whether I will get less, there is a problem. What Infosys can do is it can enter into a forward contract with a bank So this is between Infosys and the bank, where Infosys will sell USD 100 to bank, USD 100, and in return, the bank will give, let's say they agree that, okay, we will do the transaction at 79.
Hmm.
So the bank will give 7,900 to Infosys.
Hmm.
Now, Infosys has not entered into this transaction for making a profit. Okay,
Yes, sir.
they are
Hmm.
just doing it so that they know exactly how much money are they going to get in rupee terms. In dollar terms, they know $100, but converted into rupee terms, how much will that be? That they need to know, because
Yes.
accordingly they have to pay salary, they have to pay for their office expenses, electricity bills, so many other things.
Hmm.
So they are mitigating the risk of law, they are mitigating the risk of currency exchange rate movement. Their cash flow can be impacted because of exchange rate movement. They are eliminating that risk by entering into a forward contract. Because of this, they will know exactly how much are they going to get in rupee terms, and then they can plan their expenditure. This is called hedging. So I asked you that why do hedgers enter into forward contract when they are risk averse people? They are
For
not they are not buying forward contracts to make a profit. They are buying forward contract to mitigate a risk, to avoid a risk. This is
so
one
that
example.
so that's why hedgers invest in derivatives.
This is one way. This is one example of how hedging can be done using forward contract. Because Infosys would anyways get the $100, it would have had to sell the $100 anyway. Instead of waiting for that day, they fix the price in advance by entering into a forward contract.
Yes, sir. Or and even if you get even if you get even if the price even if the amount increases after 1 or 2 months, you'll get the same price.
You will get the forward price only, that is 79. Maybe the rate went up till 80, but you will get uh, a 79 rate only.
Yes, sir. Because you got an a forward agreement, sir. You're going to a forward
Correct.
contract. No.
Correct. So this process, using of derivatives to avoid a risk, mitigate a risk, this is what we call as hedging.